Guys, this view here is the city of Memphis. Fun fact, this entire city and cities across the world have been built on credit, borrowed money. This is the power of leverage combined with financial stewardship, a high financial IQ. You get to run things. Again, it's time to read.
Party, I'm in here grinding, money I'm stacking, why they rock diamonds? I can't relate to them, ain't my chick calming. I set a goal for me 2 or 3 commas. 7 figures, 8 figures to 9 figures. On a slow pace to get rich quick. Same time we just think different. Cause when you make it, it hit different.
What it do, baby? It's your partner Dale back in the saddle again for another Countermoves Podcast here on Thursday, 8:30 p.m. Guys, welcome to the show, guys. Thanks so much for blessing with your time. If you could, guys, if you're getting the value from this, man, share, which would be great. Subscribe if you're getting the value. But I think tonight is going to be a very, very, very good one, guys, for your dome, man. There's a lot of things going on concerning the economy. We actually have a presidential election going on right now between former President Trump and current President Biden. And the focal point of this entire thing is the economy. And so there's something going on between two entities in the government that I believe that needed to be talked about. And you see it kind of playing out in the real world and also in the political world. That is the government and the Federal Reserve. We call it the Fed or Fed. And it's a clash over economic liquidity, guys. This is a pretty big clash because you see this kind of clash going on when you talk about the CPI, the PPI, as well as the most known is the inflation rate. You kind of seen, and back in 2022, after the I think inflation reduction, I call it the Production Act, had been passed. You kind of saw a change in calculations when it came to the inflationary rate, right? From every 24 months to every 12 months, because the inflation rate is compounding, right? You kind of seen some playing with the numbers. You even saw also here recently with I believe with the CPI, the PPI number, how the federal government actually removed coffee out of that equation. That's kind of interesting. So you're kind of seeing a little bit of a clash right now between the government and the Fed. Now, how is this a clash? Let's kind of walk through that real quickly. Is the government, i.e., the executive branch and the legislative branch, they kind of walk hand in glove with the Federal Reserve Bank or the Fed, right? Of course, the power of the purse is with the House of Representatives, right? As well as when legislation is passed, the budget comes from the executive branch, which is the government side, and the printing comes from there. Well, the Federal Reserve is kind of seeing what's going on, and there's a lot of excess printing going on, right? Or there's a lot of printing. And so what the Fed does is they actually raise the inflationary rate to burn out that excess cash. But the problem with that is the only way that actually works is if the government and the Fed are walking hand in glove. Well, you're seeing a clash there, guys, and you're going to see here in a second, in a little bit, what that clash may look like and how you should come with that thing. But I thought it'd be wise, guys, for us to initially go through this real quickly. Let's walk through President Biden's economic chief economist, right? His view on government debt. In other words, how the government is borrowing money. This is his chief economist, his chief economic advisor. This gentleman, he actually went on to a show, guys, and what he had to say was really kind of confusing to me, guys, because it didn't make any sense. Again, let me say this again. This is President Biden's chief economic advisor. Let's see what he says, guys, and then we react. All right, here we go. Let's just dive into this thing. Here we go. Let's get into this thing. This kind of shocked me. Here we go.
should we lose? He doesn't even understand that a government bond is not the government lending anyone money. It's taking people's money. He has no idea. Watch.
Listen.
The government even borrow?
Well, again, some of this stuff gets, some of the language that some of the language and concepts are just confusing. I mean, the government definitely prints money, and it definitely lends that money, which is why the government definitely prints money, and then it lends that money by selling bonds.
Okay.
Is that what they do?
Wow.
They sell bonds. Yeah, they sell bonds, right? Because they sell bonds and people buy the bonds and lend them the money. Yeah. So
stop right there. This is concerning to me. This is President Biden's chief economist. He's not done. Let's keep going.
a lot of times, at least to my ear with MMT, the language and the concepts can be.
Notice she said MMT. That means modern monetary theory. If you don't know what that is, I actually did an entire show on what MMT is. Just go back into all my shows and you will see a strategic breakdown slide by slide of what that is. Here we go.
Kind of unnecessarily confusing, but there is no question that the government prints money and then it uses that money to
wow.
Yeah, I guess I can't really talk. I don't get it. I don't know what they're talking about. Because it's like the government clearly prints money. It does it all the time, and it clearly borrows. Otherwise, we wouldn't be having this debt and deficit conversation. So I don't think there's anything confusing there.
That right there, to me, guys, is extremely concerning. That the chief economist doesn't know how government debt works. Again, this is the chief economist of these United States of America. Doesn't know how this works. Guys, that I am thoroughly confused by that, guys. But now, guys, what do you think? Give me comments below, guys. Is that concerning to you that the the chief economist of the United States for President Biden doesn't know how government debt works? Not based on what I said. We just heard what he actually said. So let's keep going, guys. Now, guys, let's keep going. So now we understand the thinking behind what's kind of running the government right now, really the executive branch, right? We see the thinking right there, right? Now, here we go. Now, this same chief economist went on to Neil Cavuto's show, right? Which is on Fox Business, a business network, right? And Neil Cavuto fact checks President Biden's chief economist on inflation and the economy live on the show. And guys, it's not pretty at all. It's not pretty at all what actually happens. So let's see what's going on, guys. And then we can then respond from there, but it is not pretty. Let's see what actually happens. Here we go.
Speaking of the White House, honored to have my next guest, the chairman of the Council of Economic Advisors, Jared Bernstein. You know, Jared, I understand your frustration sometimes when you look at the data and Americans don't buy the data, but they really don't buy the president telling them that they're essentially wrong. It's not that bad. Okay. So how do you navigate that?
Okay.
Well, that's not at all what the president tells them. And in fact, yesterday, if you look at his statement, which is on the White House website, on the inflation report, we got a very favorable report from the perspective of the markets today, as you have been reporting correctly. But he pointed out, I think one of his first sentences is, we know families are still struggling with prices that are too high. I mean, this is practically a quote from his statement yesterday. Okay. Never will this president blow off the struggles that families like the one he grew up in are going through. Instead, he'll take action to help them through cutting costs, prescription drug, clean energy, housing, childcare, junk fees, actively working to lower costs in those areas. So not at all dismissive of America's concerns in that regard, Neil.
Notice Neil posed a question. He didn't answer the question, and the chief economist didn't answer the question. Now let's watch how it gets a little bit spicy. Here we go.
All right, well, some might disagree with you on that, but I do want to get behind why the president keeps claiming this. This is what talking about inflation.
Okay.
Take a look.
Listen.
We have dramatically reduced inflation from 9% down to close to 3%. We're in a situation where we're better situated than we were when we took office. It was 9% when I came to office. 9%. But look, people have a right to be concerned. I think inflation has gone slightly up. It was at 9% when I came in, and it's now down around 3%.
Jared, why does he keep saying that? You're his top you're the head of the Council of Economic Advisors. Do you ever whisper in his ear, Mr. President, just to be technical about it, it wasn't 9% when you assumed office, it was 1.4%. It got as high as 9% in 2022. You brought it down from that, but it was never, ever, ever 9% when you came into office. So why does he keep saying it?
Well, first of all, let me point out that in that very quote you played, the president talked about how concerned he was for households struggling with prices that he consistently characterizes as too high.
That's not what I asked you.
So
why does he keep misrepresenting this?
Watch him look down.
He's making the point
He's reading.
That the factors that caused inflation to climb to 9% were in place when he took office.
No,
I think
that's
it was
not what he said. He said it was at 9%. It would eventually get to 9% a little over a year after that. But the fact of the matter is it wasn't 9%. So if I can't trust him quoting data in real time, why should I believe what he's talking about now?
Correct.
So the annual growth in core inflation in the second quarter of 21 was in fact about 9%. And his point about inflation down 60% off its peak is very much the case. So
no, it wasn't.
Look at that. Look at this, guys. I want y'all to see. I want y'all to see this. I want y'all to see this. Look right there. You see right there at January 2021. That's when he was sworn in. The inflation rate when it was being factored every 24 months, and not when they changed into 2022 to every 12 months, which makes it a flat line. But anyways, it is 1.4%. So President Trump gave him an economy of 1.4%. Look at the trajectory here. Look at this. 9.1% in June of 2022, a year and a half after you sworn in. What happened during that time frame, guys? That's when I believe the Inflation Production, not Reduction, Production Act was passed. Production Act was passed, and boom, it shot up. So the Inflation Reduction Act was passed during this time frame down here, right? And then boom, that was a reaction to excess printing. But then at this time frame as well, guys, that's when they actually changed the calculations from every 24 months and when you're measuring inflation to every 12 months, right? I did a show on that one as well also, right? Look at my previous shows. I walked through how they did it. This is not based on what I said. This is from the Bureau of Labor and Statistics. This is a government agency themselves. They changed the calculations. It's very simple. But let's keep going. It gets very interesting. Here we go.
It was not at that. So you're almost as bad as he is. Why can't you just say it was high, it got as high as 9%? You'd be accurate in saying that. And we have now brought it down and we're struggling in around the 3% area, but it's better than it was. But instead, to hang it on his predecessor that you inherited something that was through the roof when we were in the middle of COVID, it just seems to the American people, whether you're Republican or Democrat, you're lying. Neil. You're just lying.
Hold on. I hear you. The president was making the point that I think is unequivocally true. The factors that took inflation to 9% were in place when he took office.
That is not what he said, Jared, and you're a very smart guy with this.
What factors were in place when he took over that drove it to 9%? What factors? Because when he took over, it was at 1.4%. What factors were in place? There was no factors. And notice, this chief economist said the exact same thing that the press secretary said by saying the factors were in place. These are talking points, right? No, what actually happened was, and how it's down to 3.4% is because the current administration changed the way they measure inflation from every 24 months to every 12 months. That's how they did that. So they can begin to brag about what's going on. Let's keep going. He's not done, y'all. This is good.
With this stuff, you could just whisper, and he's a good friend of yours, obviously thinks the world of you. Many others do as well. You could have just told him, Chief, I got to tell you, Mr. President, whatever you say, you might even, in fact, call him Joe. That's how close you are.
So
and
look,
just say, sir, it was not 9%. Stop it with the 9%, because the more you say that, the more people don't believe what you're saying.
Look, I think what the American people care most about is the fact
truth.
that inflation.
The American people care about truth, Jared.
Hold on, Neil. Neil, this only works if you let me talk, okay?
You haven't answered my question. I've asked it 5 times, five ways.
The president was making the point that the factors that caused inflation were in place when he took office, and that's unequivocally true.
Right.
I take your point, and we can have...
That is not true. What factors were in place that caused this? Why can't they just say our printing caused this? That was the factor you're talking about. It wasn't, was it in place, that something was in place. The factor of you actually passing the Inflation Reduction Act, right? That is what caused this. More excessive printing is what caused this. Let's stop the game. Let's just tell the truth. That's it. It's all good, baby. Hey, we thought that this is going to work. It didn't work at all, guys. We're trying to make a pivot so we can actually get it under control. Okay, cool. Gotcha. No problem. Let's get it in. Understood. Why are you blaming it on your predecessor when we can just look at the numbers and say that it's not accurate? That's a lie. Again, that was a good exchange between Neil Cavuto and the chief economist. Again, this is chief economist, the same chief economist that doesn't know how government debt works. Not based on what I said, based on what he said previously. This is the thinking, right? This is the thinking. Now, that is the government side, right? Because remember, what we're talking about is there is a clash between the federal government and this here. Okay, there's a clash, but remember, this is where the thinking is right here, guys. So, man, interesting what's going on here. I think there was a great exchange between Neil Cavuto as well as the chief economist. That was one of the best interviews that I've seen concerning the facts on inflation. Most individuals that I talk to today, they're really concerned about the economy, specifically the volatility of it. Now, the area of their concerns really centers around the variable of inflation. Inflation right now is really outpacing people's wages, number one. And number two, it's beginning to affect their 401k and IRAs because their retirement accounts are connected or intertwined with the stock market. Over the years, I've been fairly successful in real estate investing. Currently, I own about $35 million worth of real estate under management. And also my partner and I have been able to build our private equity and venture capital firm to about $1.2 billion worth of assets under management. Now, this success is taking place in up or down economies. Now, whenever there's volatility in the market, opportunities begin to show up. There are 3 investment strategies that, if implemented the correct way, any investor can go from 0 to 6 figures in the next 6 to 12 months. Click on the link below or swipe up and let's talk through these strategies. All right, guys, let's dive into what's really going on here, guys. Whenever you have a conflict between the federal government and the Federal Reserve, guys, and it's over the liquidity in the economy, there is a government plan to hack the economy. You said, LaDale, a government plan to hack the economy. Yes, guys, there is a plan to really hack this economy or to really change it. And I had to bring in my man, Mark Moss on this. And we're going to break this down, guys. And this right here, guys, this realistically shocked me. I wouldn't say it shocked me. It kind of opened my eyes to what was going on. So let's dive into what Mark is talking about, guys, and pay attention to what he's saying. And then you and I can go back and forth. Here we go. Let's dive into it.
The government can't afford to let the economy crash before the election if they have any hope of staying in power. And so they just introduced a backdoor plan to stimulate the markets and get their liquidity, and there's nothing the Fed can do about it. But the problem is their strategy doesn't align with the Fed's fight against inflation. The government needs more liquidity. The Fed is trying to remove it. So to avoid being caught in the crossfire, we need to plan ahead. So in this video, I'm going to break down where exactly this stimulus is coming from and how it's actually costing the government nothing to inject it, what the potential downsides and unintended consequences of this could be, and most importantly, how you and I, as investors, can position ourselves to benefit from all of this. Now, for anyone new here, my name is Mark Moss, and I make these videos to break down complex financial subjects so more people can understand them.
Shout out to Mark Moss, guys. Mark is one of the most wisest guys in finance that I've really been exposed to. He has great content. So if you could follow Mark on his YouTube page, guys, you will not be disappointed. Here we go.
Now, over the last 2 years, while almost everyone on YouTube has been calling for, the markets to crash, I've made over a dozen videos specifically explaining how the U.S. Treasury is driving the market and working against the Fed. And this move today is the latest trick up their sleeve.
Listen.
So let's go. All right, so we're talking about liquidity. Liquidity is what drives the markets, what drives the economy, that's what drives asset prices, and it's why we need liquidity. At least some of us want liquidity, some of us don't. What do I mean by that? So when we have liquidity, when there's more money, more loans available, there's more money for you and I, which means we can go buy more things, which means that businesses make more money from us buying things, which means they have more money to buy more things, and we see asset prices going up, and we all feel rich and wealthy and all those things. The problem is that all that money in the system pushes prices higher, consumer prices higher, or inflation. And so the problem is that the Federal Reserve, which is trying to keep inflation at their goal of 2%, said, well, hey, inflation is too high, so let's start a process of tightening liquidity. Quantitative tightening is what they call it, to slow that down. And we can see in this current form of quantitative tightening that we have right now, the current QT, the goal of the current QT is to drain the excess liquidity. They want to get the liquidity out of the system, so you and I have the opposite. You and I feel broke. We see our asset prices going down, our home values going down, we don't have as much money, so we don't spend as much. The reason why they want to do that is if we don't spend as much, then hopefully inflation comes down. But the problem is that the government is going into an election year, and they won't get reelected if we go into recession. So they want the liquidity, they'll take the inflation, but the Fed has a goal, and they need 2%. And so it's created this tug of war sort of effect. And so we have a Treasury that's continued to be taking on more and more debt. And what we can see is they're issuing a ton of these bills. So you can see how fast this has gone up. This is basically like a cash injection. So think about like a dollar in your pocket, maybe you have, we call those bills, right? A $100 bill. And that's basically because there's no duration. A $100 bill is available right now, whereas bonds could have like a 30-year duration. So bills are anything that has like less than a 1 year. So it's basically like injecting cash directly into the system. So there's been this tug of war. Like I said, I've broken down a whole bunch of videos on this specifically.
Here we go.
Now, this is officially not a pivot, and this is important to understand. So everyone's waiting for the Fed to pivot, to get off of their tightening stance and move back into an easing stance.
Now, the pivot he's talking about, guys, the pivot is the pivot of cutting rates, so that the money from the sidelines can come off the sidelines and get infused back into the economy. That money he's talking about the consumer money, because all we've had right now is excess printing of government money. The government's been trying to manufacture cash flow, right? That's why the name of my money is called a currency. The key word there is current flows. As long as the money is flowing, right, you have a healthy economy. The problem with that is if the government is manufacturing that current or that currency, the flowing of the currency, right, you have inflation. So the Fed is trying to burn out that excess cash, i.e. government printing, right? And then by cutting rates, which is the pivot he's talking about, right? That the consumer cash can flow right into the economy. Therefore, the Federal Reserve has successfully burned out the government printing, and now you actually have the real money, or the real currency that should be in there, which is consumer spending, involved. If that makes sense. Here we go. Let's keep going, guys.
Stance, which will then create more liquidity. But the Treasury is like, hang on, if you're not going to pivot and provide liquidity, we're going to do it ourselves.
Listen.
And so they've been doing this by, as I said, by selling more bills into the market. The bills create that short-term liquidity.
Correct.
And you can take a look at this right here. The bills right here are the light blue. Look at the amount of bills they put into the system. And you might notice that we haven't seen this amount of bills into the system since the pandemic of 2020.
Wow.
When the entire world shut down and they literally had to pay people to stay at home. Yeah, we're putting that much into the system right now.
So I want you guys to come back to me real fast. You see what he's showing there? He's saying that what the Fed is doing right now when it comes to selling bills or putting bills back into the economy is the exact same strategy that was done in 2020 during the beginning of the pandemic. That's crazy town. Let's keep going, guys. Let's go.
Right now, it's pretty crazy. Now, but we also have other ways that they're injecting money, even without the Fed doing the pivot everyone's waiting
clearly
for. So like this, for example, is the BTFP. It's the Bank Term Funding Program. So when the banks started going under in March of 2023, they started injecting money for the banks.
Correct.
You can see it went straight up. It's been coming down. But as of right now, we still have over $100 billion of liquidity just from this. So these are some of the stealth ways, the sneaky ways that they inject money without the Fed pivot. This is what I've been talking about for the last 2 years. When everyone else is calling for the market to crash, waiting for the Fed to pivot, I'm like, no, they already are. Here's another example right here. The Federal Reserve Board right here announces the reserve requirements exemption.
Wow.
And the low reserve tranche of 2024. So banks are supposed to have some reserves for the amount of assets or the amount of loans they put out. And what the Federal Reserve did to get more money into the system is they lowered the amount of reserves the banks have to have. It says right here, the reserve requirements for depository institutions, which will remain at zero. So you hear about fractional.
Stop right there, guys. Did you hear what he just said? Banks normally have to have a certain amount of reserves that they kind of hold at their bank, right, of deposits. Now, and it's been this for a minute, so says what Mark is showing, and he's actually correct. The reserves are at zero now. So in other words, your bank doesn't have to have anything in reserves. Nothing. That's crazy. Here we go.
Fractional reserve banking, where they're supposed to keep 10% of the amount of loans outstanding in the reserves, but here they will remain at zero. So these are all things that have been done to get more liquidity into the system, even though the Fed hasn't officially pivoted.
So what he's saying right there, guys, is consumers are looking for a pivot from the Fed, but he's saying the Fed has already pivoted by doing these type of scenarios, right? Selling T-bills, right? Which is equaling 2020, and also lowering down the requirement for banks from 10% of the loans outstanding to zero. He's saying that the Fed has already pivoted and you've missed it. Here we go. Let's keep going.
Now, if you want to know more about liquidity, which you should, because that's really what drives asset prices.
Correct.
It's a lot deeper than just this, but I want to show you the brand new thing the Treasury is doing right now. But there's a lot of ways they're getting liquidity into the system. And more specifically, there's certain types of assets that are very sensitive to liquidity. So next week, I'm going to do a live presentation. I got about 30 charts probably that I'll show all the different ways liquidity is getting into the system, and more specifically, which of the assets are the most.
I would say, guys, watch that. Scan on this code and watch that. Watch it. It's free. I believe so. But watch it. Here we go.
Sensitive and will move up the most. If you want to join me, it's free, it's live. Come hang out, look at the presentation, and join me live. I'll answer all your questions live because you want to know what this means and how to apply it. So don't miss a chance to come hang out. There's a link in the description down below. Hope to see you there. But we can see that it's not a pivot. They're getting liquidity into the system any way they can. But right now, there's a brand new way they're doing it. And the government, the Treasury, has eyed a brand new $32 trillion pool of liquidity they're about to tap into. Now, this is a pretty big deal, and it's completely independent of anything the Fed can do because it's a government policy change. And I'm talking.
Get your pens and papers out right now because he's going to let you know what they're doing. Here we go. Listen to this, guys.
About homeowner equity.
Here we go.
Right? So the reason why a lot of analysts have gotten this wrong, some of the guys that I really respect, like Harry Dent Jr., for example, I've read 5 of his books. His research is amazing. But they fail to consider how many more tricks up the sleeve the government and the Fed can have.
Correct.
And most people, including myself, we didn't think about these things. These are things like, this is another trick up the sleeve. Oh, let's tap into homeowner equity. Let's inject that into the market. So how are we doing that? Well, what we can see is that what they've done is they filed a new proposal, Freddie Mac. So the government basically provides liquidity for home loans through Fannie, Freddie, and now Ginnie. Okay, so these are like government-backed programs for mortgages. And they filed a proposal for a purchase of single-family closed-end second mortgages. Okay, so they issue first mortgages, but now they want to do second mortgages. That means they want to allow all these homeowners that have equity in their home to tap into that equity, get it out of their home, and start spending it into the market. Right now, the agency that's going to approve this is the Federal Housing Finance Agency. And it says right here, Freddie Mac is to purchase certain single-family, closed-end second mortgages as a new product. Now, that's a pretty big deal. How does it get the...
Now, guys, real quick, we go back to it. That can be in the form of HELOCs, home equity lines of credit. It could also mean second mortgage. In other words, you have an 80-20, 90-10, 95-5. That sounds oddly familiar to 2008, 2007, 6. When the banks were approving 99.7% of mortgages and home buyers only brought down 0.3% down payment. Does that sound familiar? Does that sound familiar, guys? Do not be surprised if that comes. I've seen, because I get a lot of emails from a lot of mortgage bankers as well. Don't be surprised if you begin. I've begun to see 100% financing, 100% CLV, right? I have seen that where it's an 80-20 to where, and what happened is there will 80-20, 90-10, and 10% is given, which pays for your closing costs, guys. And then what happens is if you pay the payment for 10 years, it's forgiven. Now, why 10 years? Very simple. When it comes to mortgages, most of the interest is paid in the first 7 years. That's what they're doing. But let's keep going, guys. This is getting good, guys. Get your pens back. Here we go.
Get the $32 trillion out there. Well, one thing that we can see right here is the amount of homeowner equity. Okay, so there was a little bit of equity in homes right here. Obviously, 2006, 2007, before the 2008 crash, we had a lot. But what we can see is from this peak right here to the point right here, we've seen equity go up. Here we had about 14.3, and right here today we're at about 32.3. So what this means is that homeowner equity, the amount of equity in homes has gone up by, what is that, 130%.
Crazy
so we're sitting on about $30 trillion of equity.
That's crazy.
Which is amazing. So if we can just pull couple of those $1 trillion out, inject it to the market, we can get.
But let me stop right there, guys, real quickly. Notice it says $32 trillion, right? Now, I want you to hear that number. Now, why would the federal government do this? Number one, they want to keep the game going. But number two, the debt that we have is $34 trillion. They kind of equal together, right? So from the government standpoint, we have enough liquidity, i.e., equity in real estate, to be able to make these bets, because we can infuse that cash, bring it out of the real estate and put it into the system, therefore driving economic growth. And then we can begin to kind of address this debt, but they never do. They never do. Here we go. Let's keep going.
Get more liquidity, and there's nothing the Fed can do about it. Now, let's just take a historical view to understand what kind of impacts this might have.
Yes.
So, for example, in 2007, sort of at the height of the last bubble before the great financial crash happened, there was about $700 billion of second loans outstanding, okay, to kind of set a preference. Now, today, we have about only $350 billion.
Correct.
So people haven't been tapping into this for any number of reasons, partly because the banks don't make them readily available.
Correct.
Back in 2005, 6, 7, they were just trying to give everybody as much money as they could. People were going buying second, third homes, all these different investments with that money, or even living off of it, pools, cars, whatever it may be. And so everyone was taking that money to the tune of $700 billion. And even though home prices have gone up, even though home equity has gone up, the amount of outstanding seconds is actually half of what it was before.
Correct.
Now, It should have gone up. What we can see since that time period of here about 2006, 2007, home prices have gone up by about 70%.
Correct.
Your home is worth about 70% more than it was back in 2006 or 7. But again, home equity has gone up by about 130%. But the amount of people tapping into that, like I said, is about half of that.
Correct.
Okay.
Correct.
We can see here Bank of America, which is one of the major leaders in kind of providing these secondary mortgage loans, cut their mortgage loans, second loans from $150 billion they had on their books down to only $25 billion.
Yes.
So it was a massive amount of liquidity drain that's come out of that.
Correct.
Now, this is sort of, like I said, stuck liquidity. All right.
So now, why would Bank of America actually make that type of play if this is going to be the government's move? That would be my question. Very simple. Those second mortgages that Bank of America actually had and went from 150 to 25 billion, was any of that debt government insured or government backed? And the answer is no. That's the reason why. It was too much of a risk for Bank of America. Bank of America sees that the amount of debt for consumers is going up, right? You have bank failures as well, which works in Bank of America's favor because more depository income is coming into Bank of America. The reserves they need to have is zero. Now that you're hearing rumblings of this HELOC or this second mortgage type of scenario being sponsored by Freddie Mac, then you will see Bank of America open it right back up because why? Both the senior debt, which is senior debt, and the junior debt, which is second mortgage, is going to be government sponsored. That's why they do it. The bailout partner is the government. Let's keep going.
$32 trillion of it, the government, the Treasury, they want as much liquidity into the system as they can.
Yes.
But they're sort of being held back by the Fed because the Fed's like, nope, we need to get 2% inflation before we reduce any, put any more money in.
Yes.
Now, what we can see is that in 2022, if we want to start to calculate how much liquidity could we really see maybe this year coming into the market?
Yeah.
Well, we know in 2022, about 50% of the mortgage loans that were done were what we call non-traditional
Yes,
banks.
they were.
All right. Now, the reason why that's important is because these non-traditional financial institutions, they don't have the assets to keep this onto their books.
Correct.
So they have to sell these loans in the
Secondary.
secondary market
Correct.
to Fannie, Freddie, and Ginnie.
Yes.
So they originate the loan and then they sell it to the government, basically.
Correct.
All right. Now, the reason why that's important is because there's a very well-oiled machine on the back end for mortgage-backed securities, or MBS.
Does any of this sound familiar? Does any of this sound familiar? It's the exact same thing that they were doing in 2003, 4, 5, 6, and 7, which led to the collapse in 2008. It's the same play. It's the same. It's rinse and repeat. Man, this is good, man. I hope you're writing this down, guys. Here we go.
You might be familiar with MBS if you know what happened in 2008, or maybe you've watched that movie, The Big Short.
Yes.
If you haven't watched that movie, The Big Short, I'd highly recommend it. And so basically they take these mortgage products and they package them up into securities.
They do.
And they trade them, they sell them on Wall Street.
Yes, yes.
So that's already all built. There's massive liquidity ready to absorb these mortgage-backed securities if it can only get there. And that's
My God, this is the same play they played in the 2000s. God, here we go.
Exactly what we're talking about. So now with this proposal change, we
Yeah.
can package these up from the government,
Yeah.
we can securitize them, and they can be bought and sold in Wall Street and provide massive liquidity. Okay, so how much? We're talking about how
Oh
much and how
my
soon,
God.
but first let's understand some of these impacts. So what are the potential downsides of all this liquidity? I mean, there's obviously the most obvious answer, which is more liquidity
Yes.
equals more inflation.
Wow.
Okay? So that's the battle, right?
Yes.
The Fed doesn't want the inflation.
Yes.
The government, the Treasury, they'll take it.
Yes.
I'd like to know what you think about this.
Yes.
I think that most people would rather have inflation and still have enough money, still have their jobs, still see their home values, their
Correct.
stock values higher,
Yeah.
and just deal with higher prices. I think more people would rather have that. Or would they rather see prices crash down and the prices of gas and food actually comes down a little bit?
Now here's a question, guys. Why would the government? Because remember, this is a clash of liquidity for the economy between the government and the Fed. Now, why would the government want more inflation? Simple, is to inflate the debt away. Remember, in that initial video by President Biden's chief economist, He talked about MMT, modern monetary theory. If you look up modern monetary theory, if you want to get a deep dive into what that is, again, go to one of my previous videos. I break it down line by line. But all it is in a nutshell, guys, is in modern monetary theory, or MMT, they teach that you can inflate the debt away. You can print the debt away, right? That's what they believe in MMT. You can print the debt away. So the government wants to print more money. Why? Because of the fact that because they believe they can print the debt away because they believe they can control inflation by digitizing the dollar, guys. Now the Fed is different. The Fed is trying to fight inflation. So you have a conflict between partners that should be walking in accordance together. Right now there's a conflict because the different ideologies. Government, MMT, the Fed is like, no, we need to fight inflation. So you have this liquidity fight here. Here we go.
Let me know, just comment down below. Would you rather see inflation, or would you rather see asset prices higher and inflation, or would you rather see inflation going down? Let me know. I think they'll see more inflation. So that's the obvious. But what are some of the other unintended consequences? Sure. Well, for example, it's going to put borrowers into more debt.
Yes, it will.
So right now, my home is worth, I don't know, $300,000. I owe $150,000. So I have $150,000 of debt. But if I tap into some of that equity, my debt levels go up. So now I have more debt. What's the problem with that? Well, more debt, more leverage, more risk. So for example, if the market turns down, maybe I don't have any equity left in my house and I can't sell it. So instead of being able to sell my house, now maybe it goes into foreclosure. That's a problem. We know that the elderly are very at risk right now.
Yes, they are.
They're very susceptible to inflation.
They are.
And so they could be potential targets.
Wow.
We know costs have gone through the roof. Homeowners insurance, for example, took a big jump up here.
To these factors.
And it kind of stayed at this new baseline. And here, homeowners insurance is going up. If you own a home,
it is.
You know exactly what I'm talking about. On average, it's gone up about 11%.
Yes.
But in California, Florida, Texas, places like that, it's gone up way more than that.
A lot.
And so what we know is that we already have people sort of on the brink here.
Correct.
We can see that right now today, about 23% of consumer debt is held by the elderly.
Correct.
That's a big number. That's actually doubled just since 1999.
Jeez.
And so the elderly are sort of at risk in this environment. So they might be wanting to tap into this. But again, if anything were to happen in the economy, these people could be at risk. Okay, another potential risk of doing this is that we have
how this could hurt the elderly is one product that has become very popular is a reverse mortgage. A reverse mortgage basically fronts the equity to the borrower, right? And the borrower can have access to that cash, right? They don't make any payments at all, period. And what happens is when that borrower passes away, two things can happen. Number one, the first option is for the owners of the property that it gets passed down to have to pay off that loan, right? And every month it accrues because they're getting cash every single month. Number two, if they can do that, the lender just forecloses on the property. That's all they do. It's a reverse mortgage. What he's saying there is that could cause a lot of problems, and I agree. Let's keep going on this one, guys.
We have a weaker future. And so basically what we're doing with debt is we're taking future value and pulling it in today, but it makes the future, it makes tomorrow or next year or 5 years more dangerous potentially. So we already know that, like I run up a credit card for, a vacation, but now I have to pay for that in the future. So instead of future earnings going for future spending, that future earning goes for the spending that I already consumed. So that's a problem. We know that we already talked about seniors are already on.
This is the reason why, guys, that I'm not a big proponent of forgiving student loan debt. I understand the psyche behind it, but from a fiscal standpoint, you see that actually happening right now is you forgiving money that's already been paid, and you're in a very tumultuous type of economy right now. So that wouldn't be a good fiscal thing to do right now, right? Now, when you can become more healthier, then you can look at that as an option. That makes some sense. Let's keep going, guys. Here we go.
on shaky ground. And so they're susceptible to taking this money,
Sure.
but now they're going to be even more fragile in the future. So,
Yes.
for example, 80% of seniors right now are already at great risk of financial shock.
Wow.
80% of seniors cannot withstand a financial shock. That's a pretty big number. And so if they take on even more debt, that's going to make it even more dangerous for them. And it's not just seniors. We can see 49% of Americans can't even afford $1,000 emergency. So we add up more debt. Now their payments, their monthly payments are higher, and they're going to be even more susceptible to future shocks.
Correct.
And so if we had, some sort of a recession or home prices go down in the future, we could see more foreclosures,
Yes.
things like that. And so that's one of the problems of doing this. We have a potentially weaker future,
Correct.
but today we have more money. Okay,
Yes.
now what do we do with this information now that we have it as investors? That's the big question. that
Here
we're
we go.
Watching
This
and
is-
waiting. So when we have more liquidity, again, people spend more money.
This is the part that I like, guys. Is I'm gonna like here. Is I like this way to walk through this because I'm in real estate development and finance, and I get this question a lot of the times concerning LaDale. What assets should I invest in? What should I do? I'm a big proponent of real estate, and I'm not against stocks at all, but you're gonna see them kind of dive into real estate real fast and other asset classes as well for your protection. Pay close attention to this and write this down. Here we go. Let's get into it.
Asset prices go higher. What are some of the ways that we'll see this actually manifest in asset prices? So for one, real estate.
Yes.
Obviously, if I can tap into this money from my real estate, like we saw in 2005, 6, 7, people use that money to go buy more real
Correct.
estate.
Correct.
We can unlock some of that money, but also what it will do is it will open up more loan origination.
Yes, it
so
will.
The government is basically going to be talking to these lenders and easing restrictions so we can see
Watch.
more liquidity,
Watch.
more loan origination, things
Watch.
like that.
Yes.
We can see right here a headline on Financial Times. Markets should be buoyed, should be pushed up by increased liquidity this year in 2024
that's
because
gonna be the
conditions are
pivot.
becoming easier in the
Yes.
global economy
Yes.
with an expanding pool of cash.
Yeah.
More cash, more
More correct.
spending,
Correct.
more asset prices going higher.
Correct.
So real estate will be doing that. But we also know this is only the first step in this. So like RFK, who's running for president right now, he's talking about bringing back a 3% mortgage. Right? We know Biden's running on a campaign to forgive student loan debt. And so we're going to see more and more of this government-assisted liquidity.
Correct.
Right? Not from the Fed, but from the government. Whether that's giving people zero-down mortgages,
Correct.
low-down mortgages, 3% mortgages, whether
Correct.
it's forgiving mortgage debt, whatever it is.
See that? You
We're going
see?
to continue to see more
Yeah.
and more of that. Which again
3%.
equals more liquidity, more
3%.
asset prices going higher.
Jeez.
Okay, what else? We know that global liquidity signals for Bitcoin and other risk assets.
Yes.
So risk assets are very susceptible, very sensitive to this liquidity.
Yes.
Bitcoin is sort of the canary in the coal mine.
It
It
is.
kind of moves before everything else. And so keep your eye on Bitcoin, keep your eye on tech stocks, things like that.
Yes.
Also, it should be pretty good for the economy. People will have money to be spending.
Correct.
This is what I'm expecting. Now, if you want to really understand liquidity a little bit better and understand exactly where it enters the system and which assets move first off of that, like I said, join me live. I have about 30 charts we'll break
Yeah.
down. I'll show you exactly
Scan
how
it,
you should
guys.
be watching for this liquidity. And then we'll talk about the assets that are most susceptible, most sensitive to this, and what I'm doing about that. And like I said, it's all live, so you can ask me all the questions, so you can learn how to implement this yourself. There's a link down below. I'd love to see you there.
But guys, man, a great presentation by Mark Moss. Phenomenal young man. He's probably older than I am, but phenomenal young man. Phenomenal presentation. Love what he actually had to say, guys. Man, here is my thought process on this, guys. Right? It's just here. And I'm going to put this up here because of the fact that I'm asked to do this a lot of the times. So this is going to be at the bottom. Here's my reaction, guys. All right. My reaction is this here. What's happening right now is you actually have a lot. I'm seeing a repeat of 2007 and 8. Those same factors. You heard him said mortgage-backed securities. Sounds familiar. You also hear increased liquidity when it comes to LTV via second mortgages. Therefore, you'll see a lot of reverse mortgages. You'll see a lot of junior debt being available. A lot of that junior debt being forgiven after a certain amount of time. HELOCs as well, because there's a $32 trillion pool of equity there. And so what's happening is you're seeing the government, i.e. the Fed, really the Fed, well, actually the government and the Fed kind of going back and forth on who's going to get what in liquidity. You actually see the Fed doing some actions behind the scenes already, but then you actually have the government saying we can do X, Y, Z when it comes to the FHA, things of that nature. So you're going to begin to see loosening of lending criteria on the retail side, right, as well as on the T-bill side. You're going to begin to see that a little bit, but really on the loan, the mortgage side, you're going to begin to see the loosening when it comes to a higher LTV, less qualifications. You kind of saw Bank of America when it came to the HELOC program. They had the balance sheet had 150 billion on there. Cut it down that down to 25 billion. The reasoning why is because of the fact that it was not government backed at all or government insured. Therefore, it was risky for Bank of America. Bank of America smartly saw that the debt of individuals is going up, so they had to lessen their balance sheet with those assets that are on the balance sheet that are more riskier for them. So they cut that down, right? At the exact same time, you hear rumblings right now of the government loosening up those criterias, right? So you can tap into a $32 trillion pool. Number two, to make it more safer for more loan originations, right? Because that's the only way you can tap into it is more loan products, which means you're lessening the criteria to get qualified for that as well. Also, what you typically do is you got to put some insurance on that, which is what? Mortgage-backed securities. The same thing they did back in 2005, 6, 7, and 8, guys. They caused that crash in 2008. The same thing. Now, what's it going to do when it comes to people as well? What's going to happen is you're going to have wealth advisors advise you to invest your funds into these mutual funds upon funds that are backed by these mortgage-backed securities. So, guys, when the bottom falls out, and it will because they're repeating what they did back in 2005, 6, 7, and 8, people's 401ks, IRAs, Roth IRAs, 403bs, just like it happened back in 2008, will get wiped out again. This is the same thing they did back in 2006, 7, and 8. It's the same factors, the same actions. Everything is the same, guys. So the question for you is, what are you going to do? Because of the fact that there will be no more rate cuts at all. You have to get used to paying a higher rate. If you 750 credit score and above on the retail side, 7.5%, you have to get used to that. What they're going to do to further along the economy, right, is they're going to do this whole shell game again when it comes to the real estate industry. Oh my God. It's the same thing they did. So, guys, what should you do? Here is the counter move. What's the counter move, guys? I always say peep it, sweep it, and then keep that thing, man. I don't think you guys understand what they're trying to do again, guys. This is wow. Phew. Okay. What they're trying to do. I'm going to put this up right here, this Cash Flow Club QR code, but you're also welcome to scan the code below as well also. Here's what they're going to do, guys. All right, and I'm going to go back and forth, guys. It's peep it. You got to really examine your current situation right now, right? Now, I can tell you this. Back in 2006, 7, and 8, I made a lot of my money during that time frame because I was prepared for what was coming. I saw it coming 3 or 4 or 5 years before the bottom bottomed out, and I bought so much real estate and I made so much money. Now it's your turn. You know what's going to happen now. So examine your current situation. I would say this here is, I call it peep it. Are you properly positioned to take advantage of really knowing the $4 of what's going to come. You know that the bottom is going to fall out. You know what's going to happen, right? Are you prepared for that? If you're not prepared, guys, click on this link below or scan this QR code and join the Cash Flow Club. Why? Because one of the things that he talked about is what? Real estate. In the Cash Flow Club, guys, we actually train you on how to find, locate, negotiate, structure, close, and I'll even fund your deal. You have the chance to be in the forefront before the next debacle because it's coming. And I'm not being prophetic. This is the exact same actions they did in 2004, 5, 6, 7, and 8. So what are you going to do? I would acquire a lot of real estate right now. A lot right now. Let's go back. I would say sweep it. What is your strategy moving forward? If your strategy is to depend on politicians, you're going to get wiped out again. Get this, guys. You understand? The government does not mind inflating the debt away. They're going to continue to print more money. There's going to be more inflation. What are you going to do to curtail that? It doesn't matter if Trump's there or Biden is there. They're going to do that, guys. They are going to print the debt away by inflating it away. That's going to happen. What are you going to do? What's your strategy moving forward? This is the reason why I'm putting up this QR code, and the links below is, I think, a strong move right now is real estate. A strong move, right? I'm not buying real estate. I'm not buying real estate in those major areas. I'm buying in those mid-tier towns. Why? I know it's coming. It's already at the bottom. We teach you how to locate these properties in those mid-tier towns, guys, whether it be apartment complexes, new construction, or single-family residences. It's 4plexes, 8plexes, 20 units. It's the same thing, guys. I'm trying to tell y'all, I've seen this happen before. You've seen it if you're near my age. You've seen it. All right, guys, let's keep going, guys. Keep it. Now, why am I showing you this QR code and the link below? Tell you click on the link below, guys, to join the Cash Flow Club. Because why? You got to begin to think generationally, guys. After 3 generations after you, guys. This is how I was able to buy. Guys, I was able to buy off of one investor in 2009. I bought 8 properties. Now, get this, guys. Guess how much money? $0. I'm not lying to you. $0. We teach you that strategy in the Cash Flow Club. It's called Subject to Investing. And it's going rampant right now because people's cost of living is going up, right? So therefore, they have to make the decision what bill what not to pay, right? And they want to downsize, but because they owe too much on the property, they can't sell the property. I love those type of opportunities, guys, because I get to come in and buy properties for damn near no money. I bought 8 properties, right, in 2 different states, actually 3 different states, Texas, Missouri, and North Carolina. My net worth grew $500,000 in 2 months off of 8 properties. It's the same thing that we're doing, guys, in 2008, 9. I'm sorry, 7, 4, 5, 6, and 7 and 8. It's the same play. Mortgage lessening lending criteria, wrapping that into mortgage-backed securities, right? Government sponsor, right? The banks can take a higher risk, right? With virtually no type of loss at all, because the government's backing it, and it's wrapped in a mortgage-backed security. Then the wealth advisors tell you to buy this fund, and which is wrapped in this fund, which is wrapped in this fund, wrapped in this fund, which is tied to the mortgage-backed security. It's the same play. And those that take action right now, right, guys? Oh my God. When I say wealth, when I say wealth, guys, and this debacle is going to be bigger than '08. The '08 debacle, guys, was just real estate and insurance. 2 industries. Just 2. Really 3 because you have the banks too, because the banks were originating it. But really, let's just say 3. 3, right? This one reaches every industry because the government does not mind printing excess cash to inflate the debt away. Therefore, buying something that cannot be manipulated or duplicated, real estate is a wise play. I buy real estate and silver. Do I invest in stocks? I don't. Do I invest in cryptocurrency? I don't. My partner Cliff does. I don't. Do I think cryptocurrency is a good investment? Sure it is. If you know what you're doing, just know how to play that market. Because again, just like with stocks, there's nothing backing it. It can be manipulated very easily. That's why I love real estate, right? And silver and gold. It cannot be manipulated. It's real simple, guys, man. So if you could, guys, scan on the QR code, click on the link below, guys, and man, $99, man, you get on-demand training. We do a monthly VIP call for Cash Flow Club members. I tell you, bring in your deal. Let's look at the deal, walk through the numbers, make sure the structure is correct. If it makes sense, I'll fund the deal. Let's JV this thing together. It's simple, guys. Simple. I had to figure all this out on my own. I had no one funding my deal. I had to figure it out. And I had bad credit back then. I had bad credit back then. No, I had no credit, bad credit. Now you got somebody that's been through it before. It can also disciple you on how to navigate all this. And also help you build a wealth strategy once you make the money. It's guys, man. But guys, man, I hope this helped you out. I hope that you learned something today. I hope I was able to give you some counsel, guys. Again, scan on the QR code, guys, or click on the link below. Join the Cash Flow Club, guys. You will not be mistaken at all, guys. I'm trying to tell y'all, it's 2008 all over again. It's the same strategies, guys. Also, guys, man, every single Friday, guys, at 5 p.m., Cliff and I do Real Estate Friday training. It's free. It's on all platforms, guys. We talk about real estate, current market analysis, what's going on with the economy, and then we give you a strategy that you can actually implement today to make 5, 10, 20 grand easily in 30, 60, 90 days. Very simple to do, guys. And also, guys, we do have a sponsor, American Rounds, guys. It's the first AI-powered ammo vending machine. You can buy ammo fast, safe, and automated at your local grocery store. Guys, we are exploding when it comes to machine placement, guys. We are in right now 2 states. We'll be in 5 states by next month, which would be great. We have a goal to get to about 1,000 stores in the next 24 months, guys. Man, they are a sponsor. For disclosure, I am part owner of this company as well, guys. Man, but let's listen to them. Here to go. Here's American Rounds. Here we go.
American Rounds. We are in Pell City, Alabama at Fresh Value grocery store installing the first ever automated retail machine for ammunition. The stores were really the inspiration for it. I mean, they knew their customer base and they came to us and thought this would be a really good opportunity for their customer base. There's a lot of hunting community here in Pell City and thought that their customers would love an opportunity to be able to buy ammunition here at the store.
We're super excited to offer, what we think is the first ammo kiosk. We're always looking for ways to give our customer another reason to come visit our stores. Anything that we can do to help them make their shopping trips easier based on the feedback that we've gotten just from customers today. They are so excited about us having the ammo kiosk.
We're getting ammo!
One of the ways we're changing the landscape of ammunition sales is to make it more available. Being able to move into a place like a grocery store, supermarket makes it a lot more available to the public. But we're taking a different approach to it. Traditionally, ammunition is sold at outdoor type stores, your sporting goods stores, and it just sits on a shelf. It's very accessible. Because of that, there's a high rate of theft. But with our machines, as you can see here, we have a very secure automated retail machine. We're able to age verify. We scan a driver's license. It then takes 360 facial recognition for the purchase and matches it to the ID. So the machines really provide an opportunity for safe, affordable, and available ammunition sales.
There is no doubt that foot traffic will increase based on the feedback that we've gotten. And again, we're super excited not only to have it here, but in other locations in Fresh Value as well.
We're really excited about where we're going. We are going to continue to expand here in Alabama. We have a machine slated to go into Oklahoma, Louisiana, Texas. So over the next year, we're looking forward to, seeing these roll out all throughout the South and the Southeast.
Guys, that's American Rounds. Again, American Rounds, you can go to all platforms at American Rounds, guys. And you go to AmericanRounds.com, guys, and see where the next machine will be going in your local grocery store, in your city or your town, guys. And also, guys, the American Rounds, we do not share any information with any government agency at all. So it's fast, safe, secure, and automated, guys. It's real simple, guys. But guys, man, thank you for your time. Give me your thoughts, guys, on what I presented today. Does it make sense, guys? Comment below, guys. If you want me to cover something else, as far as from a financial standpoint or social or political standpoint, comment below. Let me know what you want me to cover. I'll give you my thoughts on it as well, guys. And also, I'll be bringing some additional guests on as well also that can give a different perspective during this election time, so we can kind of sit back and reason together so we can begin to vet these candidates the right way, guys. But yeah, guys, man, thank you so much for your time. You know I end it every single time, guys, before you leave. And while you can, you see that thing, baby, take that damn picture and give it to your mom and them. And guys, holler at your partner. God bless you guys. See you next week, guys. Peace.